All right, folks, the webinar has begun. Good afternoon to our friends here on the East Coast, and good morning to the rest of the country. I'm here. This was a fun one for us to really step back and put some really cool content together and figure out like what we're doing really well with our top agents. So every one of us on the call today is on the Life Brokerage team. Everyone has their own little niche, manage their own book of agents, many of which are extremely successful. So this was a really fun exercise to not only articulate strategies that are landing with our very best agents, but to build out tools to cater to them and help articulate the concepts that we're about to share. So we called this seven for success. We have seven ideas. Some of the industry's top brokerage managers win with these niche strategies. Here on the call with me, on the webinar with me, are Nick Crescenzo, Henry Borda, Adam DeMarco, and Bob Lamar. Gentlemen, good afternoon.
Good
Good
afternoon.
afternoon.
Good afternoon.
Thanks for having
Glad
us.
to be here.
We're ready to have some fun? All right, untraditional of us, instead of a more professor-like or panel-like, we're going to rapid fire seven ideas in order. I'm going to walk you through the highlights here. So, of the seven ideas, we have an IRA spend down strategy. Henry's been working really hard on this. Really unique, kind of dovetails in with the Ed Slott concepts, but Henry puts a different spin on it. Some product structure, and then a modeling tool that quantifies the concept, right? It's easy to talk about it and it sounds great, but until you could quantify it economically and show the math behind it, it's really hard to convince a client to move. Then Adam, although it sounds kind of slow moving, he's really made some hay with this healthy lifestyle credit underwriting and rewriting and how to identify existing clients to improve their underwriting. And we've quite literally landed several $1 million of premium just utilizing this strategy. I'll share a new tool that I've been promoting for using cash value for entrepreneurs. It kind of checks a couple boxes from an estate planning standpoint and a wealth transfer standpoint and an entrepreneurial standpoint. Nick's going to jump in. He's going to talk about this massive opportunity in MIGAs and how to leverage those assets into care. The spike in interest rates a few years ago really kind of pushed MIGA sales, and they're all coming due and they are ripe for the taking. I'll get into a quick calculator that we built for clients who already made gifts. I called it the trust basis calculator. Definitely opens up some planning opportunities for your trust and estate and clients who've made some gifts post Tax Cuts and Jobs Act. Bob has a really cool strategy on guaranteed lifetime income and how he's used that in multi-generational planning and how it beats every time a qualified asset spend down strategy as far as the tradition in a traditional sense, different from what Henry's going to talk about. And then lastly, you've heard from us on this before, life insurance inside a qualified plan. But in this particular setting, we're going to show you the model that we've built to cater to that marketplace. So without further ado, let's listen to Henry Borda and how he's built, articulates, and tells a story about IRA spend down as it pertains to a legacy strategy.
Thanks, Anthony. I see you put the best looking of the group first, so I appreciate that. So I'll start with this. If you have married clients in your 60s or in their 60s or 70s sitting on a large IRA they don't need for income, this idea could be the most important planning conversation you have with them this year. So, Anthony, next slide, please. So most of us are familiar with the Secure Act eliminating the stretch IRA. So for married couples, the clock doesn't start until the second spouse dies. But when it does, adult children must fully drain the inherited IRA within 10 years. So year 10 often forces a massive balloon distribution on top of whatever the child earns. So a child in their 50s at their peak income earning years is looking at a 37 to 48% combined rate in that 10th year. So on a $1 million IRA, that could mean up to $500,000 going to the IRS, not the family. So we analyzed three strategies. Strategy number one is the do nothing. The IRA grows, RMDs reinvested. After the second death, the heirs inherit a fully taxable IRA and must drain it within 10 years. The Secure Act cliff hits in full force in that scenario. Strategy number two is just a pure spend down. So systematic distributions at 24%, after tax dollars in a side fund. IRA is gone by year 10 and eliminates the IRA problem. There's no insurance leverage in this scenario. Strategy number three is spending it down and purchasing survivorship life insurance. Same distributions, but after tax dollars fund the second to die policy. Death benefit pays upon the second death, exactly when the Secure Act clock starts, and it pays income tax free, estate tax free, if it's held within an ILET. At the
Hen-
bottom here, go ahead.
Henry, getting better leverage on the survivorship chassis. Is that what you're
Certainly.
finding?
I mean, anytime you can leverage two lives over a single life is recommended. There are scenarios that still do work from a single life standpoint, but the survivorship is, if you've got two healthy individuals is the way to go.
And what's the niche design, Henry? Do you use option C? Are you using a level death benefit option A? Or are you trying to push corridor with an option B as quickly as possible and have an increasing death benefit?
We found that one of two different ways. In this specific scenario, it was actually option one, CVAT and push and corridor.
Yeah.
Everything in this presentation and what we studied here was run at 7%. All the IRA balances, the VUL at 7%. And it does, it starts to push corridor and escalate pretty quickly.
Yeah, that's an important concept. So you're mapping the asset, right? If it's sitting in fixed income in qualified status, you want to create a fixed income alternative in the insurance policy. If it's sitting in equities, you want to create a VUL chassis to kind of mimic exactly what was happening, right? It's more of an asset mapping and repositioning of titling of the taxation is really where we're headed with this. Fair?
Yeah, spot on. So on the next slide, we'll get into the details of this specific case study. So it was a married couple, IRA owner, age 73, spouse was 71, $1 million IRA, 7% growth rate, 24% tax bracket. We looked at a 10-year level spend down, so roughly 133 was coming out per year from the IRA, paying taxes, and then using the net amount of 101,000 to fund the survivorship policy. So, upon death of insured number two, 2.63 million was paid out. At that time, the beneficiary is age 50, and normally would face the 10-year Secure Act window. So on the right in the chart here on the right, I'll walk you through each row. Year one, you'll see that the survivorship death benefit starts at 3.52 million. There is a estate preservation rider on there that doubles the death benefit for the first 4 years. But from day one, you see the leverage that is made on the policy. Year 10, IRA is fully depleted under the spend down strategies. Life insurance policy is fully paid up. Death benefit continues to grow. Year 18, the gold row. This is when we're assuming the owner dies and the spousal rollover occurs. So no Secure Act clock starts in any the scenario. Surviving spouse continues as IRA beneficiary. In year 20, the green row, this is the second death. Secure Act, 10-year window opens. The survivorship policy would pay out 2.63 million income tax free to the ILET. Children receive it with no inherited IRA rules attached, total control and flexibility from that standpoint. So it's 442,000 more net liquidation value than the do nothing strategy, and it arrives with no 10-year countdown or forced liquidation. So, this is just kind of it charted out. This is measured at year 30. This is the end of the beneficiary's 10-year Secure Act window when that year 10 balloon tax event occurs. So same growth rate, all three strategies. The do nothing would be 3.75 million, pure spend down just over 3 million. And then the spend down plus survivorship life insurance is over 4 million, and it's the clear winner. It's nearly 350,000 more than the do nothing strategy, and significantly
Henry,
more than the spend down.
Henry, noteworthy here. This is on the very back end, right, where insurance starts to taper off. Obviously, an earlier death creates a huge disparity for the spend down with life insurance. But I think from an access, a flexibility, and control standpoint, particularly if the policy is owned by a trust, you can do some really cool things from a creditor protection standpoint and estate tax distribution standpoint, survivor lifetime access. You can get really cute with trust provisions. So the math is the math, but let's not lose sight of flexibility and control of that asset, um, particularly when it's held inside of a trust. Now, for those IRS haters, Henry, what's the impact here? What are we saving by doing this now versus, as Bob Lamar sometimes says, what do you say, Bob? You want to pay tax on the seed and not the harvest? Is that
Yep,
the
that's it. Pay the tax on the seed, yeah, instead of waiting, paying tax on the harvest.
yeah. Henry, what's
Yeah,
the outcome?
yeah. So I mean, this is a graph of the taxes paid under each scenario. So the do nothing bar has two layers to it: 332,000 in owner life income tax, plus the 901,000 in beneficiary income tax after that second death. So the total family tax bill in that scenario is 1.2 million. In both of the spend down strategies, that beneficiary tax number is eliminated entirely. So it's just the owner distributions that are taxed, and they're equal to about 320,000.
Nicely done,
So
Henry. And in the essence of time, I know you put together these summary slides, but you have access to a very extensive model that compares the do nothing versus the spend down versus the spend down in life insurance in a year by year, extremely analytical fashion.
correct. Yep, exactly.
So, Henry, just to bring it home on idea number one, who's the ideal client, and then what do you do? What do you do? Where do you go from here?
Yeah, so married couple, ideally, ages 65 to 75, obviously need to be in good health. The better the health, the better leverage you get on the life insurance death benefit. IRA balance of 500,000 or more, that's not needed for income. The primary goal being leaving a legacy and wealth transfer to their adult children. Also, you need to have adult children kind of in the higher income tax brackets that are going to face significant Secure Act taxes.
Hmm.
Um, and then from here, for us to, kind of just run the same type of analysis and client friendly output and modeling, we just need to know the IRA balance, both ages of the insureds, the tax brackets for the owners and the beneficiaries, and we'll run the full spend down analysis and navigate kind of best carrier and product and integrate it into a client friendly
Yeah.
presentation.
Yeah, the Secure Act, Henry, just presents so many dangerous unintended consequences, right? Leaving a lump sum to beneficiaries, kids, grandkids, nieces, nephews who may not be ready to inherit a lump sum or may not have a proper lifestyle or education, and as it pertains to investing, maybe married or future ex son-in-laws or daughter-in-laws, right? It just presents so many complications. And not only are you proving out the math, but you're proving out the flexibility and control of the asset. So wonderful job. If anyone has questions, please type them in the chat. We'll address all of them at the end. Henry, really well done. Adam DeMarco, my business partner, he's sitting at the home office of Nationwide in Ohio right now, is kind enough to jump in here. Adam, talk to us about specialty underwriting and particularly healthy lifestyle credits that you're using to improve underwriting offers, rewrite existing policies, and kind of showing us some premium.
Yeah, it's really a significant opportunity. So it's for people like you, Anthony, that know about words like quinoa and kale and macros and try to do these things that are helpful health wise. So you have a situation here where, excuse me, just one moment. There was a little bit of feedback. You have a situation where traditional underwriting, which is what all carriers still do, is just a debits driven scenario. So they start at a perfect Olympic runner who's got no health and perfect family history, and then they look at everything wrong with you and they basically just debit out things. And they say, okay, your bill is not optimal, or you're on medication, or you have this condition, right? And there's also a credits driven model, which some carriers are focusing on now. So you could have two people that are identical on paper and completely different lifestyles with regards to what they do from a standpoint of how they work out, what their lifestyle is like from, from a standpoint of how they from how they live, if they're involved with their family, all different types of things that are important for an insurance company to know about. And what we do is we identify them. We've looked across all of these different carriers and seen instances where we've gotten meaningful improvements on underwriting offers, and we've kind of identified these series of questions, and then we write a cover letter to make the person kind of pop off the page. And if you got two people again and they're identical in their medical profile, but one maybe doesn't isn't involved in their community, isn't involved in the lives of their children, isn't involved in it doesn't have things like owning a dog or a cat, all of these different things, living a healthy lifestyle, they can get significant credits. And we've been able to get people who are limited in what they can qualify for, something like a type 2 diabetic who might be 50 years old. That's somebody who's limited to standard, maybe standard plus at best. We're finding that some of these programs can take these clients on at preferred plus. Essentially, anybody who doesn't have a personal cancer history, even if it's a cardiac history, if they're doing the right things, which is always whenever we're talking with agents or talking with clients, it's always the same answer. And it's true. A lot of times is, you should see this guy. He's healthier than me. Why is he getting rated? Why is he, yes, he has a heart condition, but he's following his doctor's orders. And carriers traditionally, under the traditional underwriting profile, they don't take into account how this person's living their life. They only hold against them what they've been diagnosed with. And there's certain carriers that are now adopting this healthy credit model where for certain clients, if you could provide some of this additional information, they're essentially throwing out their guidelines. And we have some examples on the next slide there.
Incredible, Adam. And you're using both a manual approach and technology to identify policies that are on the books and approaching agents proactively and making a request like, hey, why don't we give this gentleman or lady another shot? I mean, we feel like we have credits here that we've identified in the past that are applicable today that weren't applicable at inception. We we can either save some premium or buy more coverage for the same dollar amount.
Yeah, and the agents that we work with, and we ourselves, we really pride ourselves with getting everybody the best deal that we can get. We go out to the whole market every time and work a case, and we've been limited because the guidelines limited us. So now that these new guidelines exist and this new approach exists, and carriers are, not only are they taking a different look at clients, but we've identified successes. We're recording and sharing it with the team amongst ourselves and share it with the agents what works and what type of things do get these credits.
Yeah.
And it's not just the things that you would think about, like I joked about kale and quinoa and things, but healthy diet's a big thing, and regular exercise. But something like going to a dentist, huge. That's a very big thing. People that proactively do that. If they do certain preventative maintenance things, the regular lab work with their doctor or vaccines, that can get a clean driving record, which is going to be pulled anyway, but we want to use that as something to our advantage. Again, driving record, historically, only something that counts against you. Now we're counting it for us, right? Active in their community. And, if they own a dog or cat, studies show that people that own a pet, I happen to be a dog person, they actually live longer than those that don't on average. So that's something that can help. Financial things, like if someone has quality health insurance, many people do, we could position that people that have health insurance live longer than people that don't. Makes sense because they are more willing to go to a doctor if it's not going to cost them. Income is a big thing. Having a college degree can lead to longer longevity, and being in certain metro areas. A lot of our clients are in the Northeast region where they're within, a certain distance from a major metropolitan area. Major metropolitan areas tend to have more hospital choices. That is also correlated to it. So it's about creating this narrative and going through and creating a profile and presenting the case, not just on the underwriting, merits where we're trying to limit the debits and show that this person is a healthy version of somebody who has an impairment, but say that they are actually a quality candidate that you'd want to insure. And logically it makes sense. And when you talk about all the clients that we historically have been happy to get standard for, I use diabetes as an example just because it's so prevalent, but that people in their 50s getting a standard or standard plus with diabetes was something that we would take that as a win because other carriers, many carriers, especially those without these kind of credit systems, they'll even give a table rating. So for us to now have an ability to get preferred or preferred plus for all these conditions, basically think of it as any condition other than cancer, personal cancer history, things like family history that clients can't even help, or maybe they have some kind of strange, medical situation that's dormant. So all of these things are now on the table. So we have at Life Brokerage, we've sold over 13,000 term policies over the course of our 13 years. So we're just going through and just looking through them and identifying it. And we reach out to the agents. Many of you on the call hear from us and say, "Hey, you sold this case 3 years ago, 5 years ago with us. It was a great offer at the time. It's standard. I think this person can qualify for healthy credits. Let's look to save the money." And the savings is really meaningful.
Yeah,
And Anthony
Adam,
mentioned that we've,
yeah, this is great, Adam. So the folks on the call, there's a lot to take in here. So one suggestion that the team made was let's add some of these lifestyle questions to our preliminary app. So if anyone thinks they might have a potential candidate to apply some healthy credits and upgrade, you may want to request a copy of our preliminary app where we have a lot of these lifestyle questions embedded, and we'll take that data and it'll help us craft a cover memo and get out to the market. So Adam, just real quick, maybe want to bring it home. If your client isn't preferred plus, you want to start relooking things, right?
yes, and
Some
we
closing
can,
thoughts?
and many of you might be thinking, well, how do, I've sold a lot of policies. How would I go back and do that? If you've sold those policies with us, we can give you a list of all the policies that you've sold and the health rating. So, and identify them and start to work on those things together. And we keep pretty detailed notes in our system as to why people got certain offers. So we're able to identify that. We had a situation a couple weeks ago where carriers changed how a couple carriers changed how they handle coronary calcium tests, which is something that can limit people as well. And we were able to pull a list of those and reach out to agents and say, here's the policies that were affected by this previous guideline. New medical information has changed guidelines. So we could get involved and get you this information and start working on stuff right away.
Nice job, Adam. Thank you. Tell our friends at Nationwide we said hello.
Yeah, we'll do. Thanks.
All right, I'm going to jump in here. Idea number three. There's so many agents that we work with that are so successful, particularly Guardian, Mass Mutual, Penn Mutual, Northwestern Mutual, that use cash value life insurance as a capital platform. So there's two boxes you want to check to make sure that you are making the right recommendation. First is that the death benefit, the need for death benefit exists, right? That's obviously super important. If you don't have a need for death benefit, this is no silver bullet. But if there is a need for death benefit, and then you have a family or an individual who is entrepreneurial and looks for funding to do deals, whether it be real estate, private equity, small businesses, angel investors, whatever it may be. Um, Here's a really cool strategy that just kind of opened up for us over the last couple of weeks. So in this particular strategy, we're funding a cash value contract either annually or through a premium deposit account. And then we're subsequently pledging the surrender value and the premium deposit account. This is a relatively new development in the market. Banks couldn't really get their heads around the premium deposit account, but now they've kind of learned. Some major banks have gotten comfortable with this and understand that it's as liquid as it gets. Which allows you to almost immediately deploy or draw on that line of credit against where the PDA is being used as collateral. go out and do your entrepreneurial deals, create a bucket of side wealth or alternative wealth, and then to exit the bank loan, you're going to have a bunch of options. You could repay it from your alternative investment. You could refinance to a policy loan, or you could even hold it, for death. So in this particular example, at a male 50, female 50, they buy income producing real estate at a cap rate of 12%. So it'd be very easy for them to buy and hold appreciable real estate at a rate of 12% if the bank loan costs 6, right? And of course, they need $13 million of death benefit today, 30 million at age 85. So we're kind of checking all the boxes here, and I'll get into a model in a second. $500,000 premium, 10 pay contract. The contract is a survivorship whole life. I can organically break even in the contract by year 6. The model that are showing here, and I'll get into that in the next slide, is that a premium deposit account funds all 10 premiums at a discount. At the end of the first year, a $3 million entrepreneurial capital opportunity comes up. We pledge the premium deposit account. We hit the line of credit for $3 million, and we service 6% interest out of pocket. The strategy added 35 million of benchmark value, and I'll talk to you about benchmark value, because the honest comparison is not this strategy versus doing nothing, and that's how it's often talked about or shown. The model deploys the same cash directly into the investment without borrowing, because there's an annual interest out of pocket expense, right? So the true benchmarking involves taking the $3 million lump sum and going out and investing alternatively while servicing the debt, versus just taking the debt service and investing in the same 12% investment. And in our benchmarking, positive means it works. So we create 35 million of strategy value above the benchmark at age 84. We have $30 million of income tax-free death benefit delivered on top of the leverage result that we're showing. So there's 2 levels of optionality here, right? You have the leverage strategy, and then you have the policy itself. So going back to, you need the coverage and you want access to capital to do cool things. We built a really sophisticated model here that shows this, and it's a little small to see on the screen here, but you see the policy values. We did a premium deposit account of I think it was 3.8 million to pre-fund all of those 10 premiums, and we hit the line of credit in the beginning of the first anniversary. Let that cook in an alternative investment. In this example, is 12% appreciated real estate for a 20-year period. At the end of the 20th year, we had a liquidation event, repay the bank, and you see the results that were impacted. This was a buy and hold strategy. We can toggle on and off if we want to recognize income taxes on an annual basis, or buy and hold and recognize it at liquidation, which we did here. You see the tax on the liquidation. It is a really, really powerful story. You do not need a high early cash value product. You do not need to sacrifice performance of the contracts. This is my favorite survivorship whole life contract in the marketplace. And you couple that with some cool new banking opportunities and a really slick design. And I think you could really make some rain with that. And we have some producers who are doing a really nice job. So moving into idea number 4, Nick Crescenzo, care planning. Talk to us about the opportunities where dollars sitting are sitting in MYGAs or any type of fixed income, cash equivalent for that matter, and then leveraging into care planning.
Thanks, Anthony. There was back in March of 2022, we saw an increase and kind of an explosion in the interest rate marketplace, and it just kind of kept growing and growing, which in turn led to increased interest rates for the MYGAs. As you can see, $66.2 billion of MIGAs are maturing or coming out of surrender in 2026. And of them, there's just 3 years, there's 41.4 billion. Now you can take a look at all these. We're always trying to find the low hanging fruit. And this tended to kind of fall into those guidelines of the low hanging fruit. Where are we getting the money from? Well, this is that low hanging fruit here that we look to kind of redeploy and see how we can get creative to kind of get leverage. Another important note is 76% of MIGAs, believe it or not, auto renew without a new application, meaning that whatever that renewal rate is, instead of doing paperwork, they basically just roll them over to the guaranteed rate, and a lot of times sacrifice, getting a higher interest rate. Now, they may not, quote unquote, need these funds, and ultimately their goal is to pass them down to the next generation. So what we've done here is we've looked at a couple different paths to reposition these funds, which you'll see on the next slide. One of them we could reposition into a SPIA, and we can use that to leverage life insurance premiums from that SPIA. We can also look to leverage it for long-term care, which is what my main focus is going to be today. And then we could also look at leveraging them into the fixed index annuity market or just guaranteed income, any type of estate type of planning, objectives. In our research, we looked at, what we see most often, and that is just the rollover of these types of MIGAs. We have a 3-year, we'll roll it into another 3-year, we'll roll it into another 5-year. And while that's all good and fine, we're just looking for other ways to create that leverage, especially because there's many people who do not have long-term care coverage. So what we look to do in this particular scenario is we have a male 65, $500,000 non-qualified multi-year guarantee annuity. So all we did, instead of just rolling that over, what we did is we took a portion of that. We took $200,000 and we put that into a SPIA, 10-year period certain SPIA, which spit off about $24,000 of income. And then we netted out the taxes. This particular insured was in a low tax bracket, and we were able to get $21,000 of 10-year premiums, which in turn was able to provide us with a $8,000, call it $8,500 a month initial monthly benefit. Now we have inflation on here, and there's also a total benefit pool of $660,000. So you're turning that 200 into 660 for long-term care protection to then protect other assets just from making a small change. And with the other 300, you can go ahead and do what you wish. You could roll it into another MIGA, continue earning, on that 300,000. Now, this particular one was a single life. This assumes that this person's married, the spouse has coverage, and we're just doing this on a single life. Now, in the second scenario, we're assuming that they both need coverage. So the same premiums, we're just throwing those in there as well. And in the second option, we're looking at, now obviously you'll see a lower monthly benefit because we have 2 lives here. We're looking at $4,700 a month per insured. Now this duration is 96 months, although you're turning that 200 into 500,000, which is growing at 3% compounded inflation, which is giving you that leverage as well to protect both the spouse and the actual holder of the single life MIGA. So that's kind of the first step here in this scenario, is just kind of leveraging for these asset-based long-term care type of scenarios. Recently, Nationwide, I know Adam's at their conference now, but Nationwide came out with a product that is very similar to the For-Care product, which is an annuity option. So the annuity option is really cool, and you could obviously just do a 1035 exchange into this, and with MIGAs in the annuity space, you can actually do partial 1035s, which is not available on the life insurance side. In this particular scenario, we just took 200,000 and we transferred it to the Annuity Care Matters product. And with that comes a 3% guaranteed rate of return. Also comes a 3% inflation rider, which you will see, we're able to turn this into right back to the $8,500. And the important part to mention here in this sale is with the product, you basically have very limited underwriting. There's no exam. It's basically questions on the application. And then with that, there's basically whether you get approved for 2 times leverage or 3 times leverage. 3 times leverage would be preferred, or a standard offer would be 2 times leverage. And basically, the moral of the story here is you're getting that rate of return still. You're locking in 3%, which many times is higher than what these auto renewal MIGAs will kind of impact your policy. The other item is you're going to continue to grow that long-term care pool in the same similar scenario like you did with asset-based long-term care with the Care Matters product, although it's a lot less limited on the underwriting side. And to wrap things up here, there's another option here. If you're looking at the CD portfolio, CDs are going at roughly 4%. That's what we're using here. You could turn that $100,000 with a preferred individual. You could turn that into $300,000 of base long-term care today. Now, obviously, as I stated before, it's a 3% growth rate. It's also going to be, in this scenario, we selected the 5% compound inflation. You can see the difference from the left to the right. There's obviously a big difference there in benefit for long-term care need.
Nice job, Nick. And sticking with the theme here, Nick has built a modeling tool to compare the qualified dollars being leveraged into tax-free long-term care benefits. The true benchmark there is to just allow the qualified asset to continue to grow in a compound tax-deferred nature, distribute RMDs, pay your taxes, reinvest the RMDs. So the comparative is the do nothing strategy, reinvest RMDs versus leveraging a SPIA purchase into long-term care. So whether it be life or annuity. Nice job, Nick.
Thanks, Anthony.
All right, I'm going to take this one back. So we've done some research, and a lot of clients made some pretty large gifts since the 2017 Tax Cuts and Jobs Act, when the exemption doubled. One key point is that although they made some really wise decisions from an estate planning perspective pertaining to estate taxes, the unintended consequence here was that virtually every single asset class has gone up over the last several years, and trusts, unlike individuals, do not get a step up in basis. So appreciation of trust assets become a tax bomb. The bill grows every year. The longer it compounds, the larger the embedded gain, and the larger the tax due when that asset gets sold. So there's only two ways to solve it, right? You can swap those assets out, provided the trust allows for that, which almost every trust does, where you could exchange a high basis personal asset for the low basis trust asset to reset where the gain sits and hopefully get a step up in basis. But not a lot of clients have millions of dollars, sometimes tens of millions of dollars sitting around in cash to facilitate that swap. So the easy and prudent diversification tool here is to buy life insurance, right? You position a policy so the family beneficiaries have some tax-free liquidity to pay the capital gain tax when assets are sold without forced selling at the wrong time. So we keep talking about optionality, flexibility, right? Having the trust acquire a life insurance policy gives the trust and the trustee that flexibility to do and plan on their terms and not someone else's. So, again, sticking with the theme, we built a trust basis calculator, and you'll see a $25 million gift in 2018 that appreciated at 10%. I mean, there's virtually almost every asset class available to an accredited investor has grown at 10% over the last 8 or 9 years. The tax ramifications on a long-term cap gain rate, particularly at a New Jersey trust at 34%, is astronomical. So you'll see, even in year 5, a $25 million gift in 2018 that grew at 10% in a 34% combined long-term cap and state rate. In year 5 is 5.2 million. In year 25, it's 83 million. So, there's some real liability here where clients are going to be forced to either swap assets or fund the tax with life insurance, at absent of a fire sale. This is a big planning strategy that some of our wealth transfer agents are using in their centers of influence in the world that they live in, which has been really resulting in some really big cases where assets are already in trusts are already in existence, and you're just funding for liquidity. So moving right along, My friend Bob Lamar has worked on this case with one of our attendees here, who's an attorney by education and a financial planner by practice, and really clever idea using guaranteed lifetime income. Um, Bob, why don't you walk us through this particular case study and answer some of the questions of right two paths, same retirement goal, which delivers more after-tax dollars in this particular case. Give us some background on the case, how it evolved, and then what your decisions, how the decision tree went with the two paths.
All right, you bet, Anthony. I guess I'm going sixth, and Henry said that we're starting off with the best looking first, so I see where I stand here. But I want to today I want to walk through a case study that answers a simple but important question on how do we create more tax efficient retirement income, and not just your gross income, but what really counts is your after tax income and over a client's lifetime. So we're going to be comparing a non-qualified annuity versus a qualified IRA, and we're going to focus on delivering more income with a low. We're comparing one option A is $1 million annuity, non-qualified annuity, and we're showing it producing $88,400 of guaranteed annual income, starting at the insurer or the annuitant's age 61.
Bob,
And
would you mind if I just set the table just for a second here for you? So,
sure.
so the fact pattern of the case is you have a mature qualified plan owner with a balance of 1.5 million. Fairly conservative investor, gave us a 5% assumption to work with. Wanted to create a guaranteed lifetime income or wanted to provide an annual income through gifts to his adult age son. Did I understand that correctly?
Yeah, that,
Bob, I think we're losing your reception. You might want to try to go off camera and pick it back up.
all right. How's that?
Better.
Okay. Now, yeah, what I did was I wanted to show this scenario because this is something that we've been coming across a lot more where IRA owners, because in this case, normally we would use a Roth conversion strategy, and then the non-qualified annuity would produce the income completely tax-free. But in this scenario, we're showing an adult, a parent owning the IRA, deciding, do I gift them the IRA now? I want to start giving them their inheritance now versus waiting till I pass. And do I gift them their annual income every year, or do I just gift them the whole thing, have them pay the taxes, net that out, and put it in a non-qualified annuity? What's gonna benefit the child, more so the having the income paid out over a period of time from the IRA directly, or just having the full thing gifted and like I said, by the non-qualified annuity. So what we're going to do is we're going to show an apples to apples comparison after tax of the two different options, and we're going to show what the basically the net result is.
So you have an educated consumer, Bob, who identified the tax ramifications of owning 1.5 million in a qualified IRA and was willing to trade that for $1 million of non-qualified asset by paying the tax all at once. We lost you again, Bob. So I'll jump in here. So in this particular example, the entire funds were liquidated. There was $1 million net left over. Generation A transfers the $1 million to Generation B, all basis. Income to begin at age 61, so a 4-year period. That $1 million threw off 88,400 guaranteed lifetime. There was an exclusion, pretty significant exclusion, earnings first, right? This is LIFO, particularly in the early years. So over the lifetime, with the exclusion, and even after the exclusion runs out, lifetime of taxes paid are $661,000, all up front by the mature qualified plan owner, and year by year over the adult son's lifetime. So lifetime after tax cash, $2.3 million. So the remaining contract value is obviously taxable to the beneficiaries. There's a free withdrawal surrender charge period of 9876543321. So if you look at the right side of this comparative, the qualified plan, we want to pull 88,400 out, plus we're going to have to gross up for any particular taxes through age 89. The income lasts through age 89 and then stopped completely. In this particular example, using the qualified spend down strategy and subsequent gifts to their adult age child beneficiary, generation B, you're looking at $1 million of lifetime tax paid. So it's roughly a $340,000 savings in lifetime taxes, not to mention an additional $300,000 in lifetime after tax cash. So, the math here kind of speaks for itself. Bob, did we get you back?
Yeah, how's that sound? I
Good.
apologize. I'm having some technical difficulties, but and I'll jump right back in and what we're looking at here is, through age 95, the annuity produces about $308,000 more in in income and saves roughly $340,000 in taxes. So more importantly, the IRA runs out at age 89, while the annuity is guaranteed to pay that income out for the client's life. So same income earlier on differs later with the outcome, but importantly, we know it's going to be there forever, and he's also going to have more income and better tax savings with this strategy.
Great outcome, Bob.
Mhm. Now, with this is also some of the six different reasons why this product is such a great fit. And one of them is the guaranteed lifetime income we just talked about. It also produces a 0% floor. So, it has the downside protection, tax efficiency, and then there's a deferral bonus. So if he doesn't want to take the income, right away, in this case, he delayed it for 3 years, he's going to have a 10% deferral bonus each year for the 3 years that he's not taking income, which is going to significantly drive up the amount of income he's going to take.
Okay, Bob, we lost you again. So we'll wrap with no required distributions, income enhancement benefit. Really cool strategy for this combination income planning, gift planning, and multi-generational income planning. Appreciate the work here, Bob, and presentations are available again, through Bob Lamar, and we'd be happy to model this out for you. Last but not least, you've heard us on this one before. What we've done differently is built a model to again quantify the story, so that the tax drag on the largest of IRAs could erode 75% of a value. Starting value of a $2 million IRA, you have an estate tax subject to estate tax of 800,000, an income tax of 444,000. You're left with 756,000. It's so unfair that the IRS gets more than the family on a $2 million IRA. So, what we're doing here, and I'll walk you through the math, is we want to be able to roll the IRA into a qualified plan that allows for the purchase of life insurance with pre-tax dollars. We want to quick pay that policy over typically a 5-year period. We want to swap that policy out to personal ownership, or preferably an ILIT or SLAT. We're going to replace the qualified plan value with cash, and we'll continue funding the life insurance if we want to, but not necessary. You'll see in this example of the model that we've been able to articulate on the do nothing versus soaking up those qualified dollars using a 5-pay life insurance premium and then a subsequent swap. So you bring us the name in closing here. we do the modeling, right? And if we can give you any takeaways from what we talked about this afternoon here on the East Coast and this morning for the rest of the country is right. Who has a MIGA or CD renewing in the next 12 months, right? We saw $60 billion plus. Who's charitable and age 70 and a half or older? Who has an IRA worth more than $1 million that they don't need for income? Um, who's age 70 to 80 and hates the tax on RMDs, right? Which clients aren't preferred plus in your book of business? Who's a ultra high net worth client with 4 million or more in qualified plans? I mean, start looking through your clients and centers of influence. Send us some names. We'll have models back to you within 5 business days on all of these niche strategies. We appreciate you spending some time with us. Um, 7 niche strategies, one expert panel. I mean, this team is some of the best in the business. Ask us anything, use us as a resource, and let's win your next case together. Our contact information is here. You can reach any of our brokerage directors at Life Brokerage. Again, we appreciate your time. Sample models, copy of the slides will be sent out by the end of the week. We can't thank you enough for being with us. Nick, Henry, Bob, thank you for joining. We lost Adam a little bit earlier to a nationwide home office fly-in visit. Gentlemen, thanks for being with me today. You did an amazing job, and we'll drop this here, and our meeting is adjourned.
Thanks, AJ. See you guys.
Thanks,
Thanks,
AJ.
guys.